Now, obviously, they've had a great return on this investment, right? Buying it for 100, and walking away with $700,000, that's great. But again, as we talk about, that $200,000 figure being sort of something of a shortfall in terms of retirement savings, this is where that the difference is ultimately going to have to come from for people to kind of get through their retirement journey successfully. Reverse mortgages, right? That's what we're here for. Let's talk about it. So what is a reverse mortgage? I'm just going to give you sort of a textbook definition here, and then we're going to kind of dive deeper into this. A reverse mortgage is a financial product primarily designed for homeowners 62 and older with limited income to convert a portion of their home equity into cash while retaining ownership of the property, or to purchase a new property, right? We're going to talk about reverse for purchase and how it works and why it's such a powerful tool. But for the most part, it's a product that's used to kind of help people stay in their home and take some cash out. The loans do not require any repayment until a maturity event occurs. And that's either selling the property or moving out of the home. So when you take on a reverse mortgage, right, you do not have to make any monthly payments on that outstanding balance. And moreover, in certain instances, we can actually kind of annuitize the equity in a property and give somebody a cash flow distribution every month. But it is a very, very good retirement tool for that purpose because it helps people manage their cash flows a lot better. There's different types of reverse mortgages, but the most common is the FHA, Home Equity Conversion Mortgage, also known as the HECM. Common applications for reverse mortgages, right? Pay off a forward mortgage and eliminate monthly payments. So, this isn't really relevant for a reverse for purchase transaction, but if a customer has a loan balance outstanding on their home and they want to refinance that loan balance into a reverse mortgage, they no longer have to make monthly payments on their mortgage, and they get to stay in their property, right? So that's a great kind of cash flow application. Another application for somebody who maybe doesn't have a mortgage balance outstanding and has just a mountain of equity in their home, we can set up monthly distributions and create a tax-free income stream, right? We get to annuitize that equity in their home and give them a monthly distribution of income. Another application is really just to establish a line of credit and draw funds when needed. When you understand more about this program, you'll understand that it works very, very similar to a home equity line of credit that a borrower can just sort of set up and just kind of use for large one-time expenses, maybe home improvements if they have to kind of do some modifications to for aging in place. Adding an accessory unit, that's also a very, very common application, but it does function very similar to a line of credit. And the last one here that we're going to talk about is finance a purchase with limited income requirements and no monthly mortgage payments, right? So again, the big one here is that retirees have less income than they did, when they were fully employed. This is the loan program that allows them to finance real estate with the limited income that they have, in their kind of retirement phase of life. Eligibility requirements, right? This is very, very different than a standard mortgage transaction. The borrower does need to be 62 years of age or older, 55 for certain programs, right? There are, other reverse mortgage loans out there, that operate a little bit different, and 55 for certain age programs. However, for the bulk of the transactions that are being done, you do have to be 62 years of age or older. There's no minimum FICO score requirement, right? I mean, how many times have you heard that your buyer doesn't qualify because their credit score isn't high enough, right? That does not apply on a reverse mortgage. We aren't necessarily, interested in how low or high the credit score is. It's not even part of the kind of underwriting approval process. You do have to occupy the property as a primary residence, right? That is a major one. We can't do this loan program on an investment property. We can't do it on, a second home. It does have to be the buyer's or the borrower's, primary residence for it to be eligible. So you can't have it on multiple properties, as an example. And a big one is you just can't be delinquent on any federal debt. That's part of the program. So assuming you check those boxes, the buyer does in fact, qualify for this type of program. Eligible property types, it's kind of the stuff that we're all familiar with, right? A single family residence or a townhome. You can do that all day long. Multi-unit properties, if you do have those in your market, a 2 to 4 unit property, this is a great application because, a buyer could buy this type of a property, or maybe they already own one. If you're not making mortgage payments, right, the cash flows on that property get a lot better because they're able to keep more of the rental income that's coming from those auxiliary units, because there's no mortgage payment due on a reverse. HUD or FHA approved condominiums, right? So you probably are all familiar with the FHA program. This is part of the same kind of family of products. It's a government kind of lending program here. If a condominium is not currently approved for FHA financing, that's not a problem, right? We can do an approval. We can facilitate getting that project approved as long as it meets the standards for FHA financing. We can do a transaction on it, so don't let that worry you. And then manufactured homes that meet FHA standards, right? The big one there is having a fixed foundation. So a lot of property that this is eligible for. You can't do commercial, nothing like that. It's residential real estate only. But it's not safe. Okay, I want to kind of take this one head on, right? These loans do have something of a predatory past and a negative stigma that is attributed to them. And I have to say, it's well earned. The product used to be, pretty bad and very predatory, and a lot of people got into trouble. So, most reverse mortgages are in fact regulated by the Department of Housing and Urban Development, HUD, and the U.S. government has been proactively adding industry safeguards to make the program better for consumers, right? So the reverse mortgage that a lot of people think, and remember, is not the same reverse mortgages today. Let's go over some of the reasons as to why the product has just improved significantly from where it's come from. The first one is reverse mortgage counseling, right? So before submitting a reverse application, borrowers are in fact required to meet with an independent third-party HUD-approved counselor. Reverse counseling is an impartial educational resource to help seniors and their family members make an informed decision about reverse mortgages. The process is mandatory for all reverse mortgage transactions. So, even if this is the best product for your particular, customer, and even if, you highly endorse it, and maybe, the lender, at rate does a great job kind of selling the program and saying why it's so great, all the positives, right? Even if the borrower does in fact want to proceed immediately, they still have to meet with an independent third-party counselor to make sure they fully understand everything that they're signing up for, right? So that's a big one. Non-recourse protection, another big one. This is a non-recourse loan, okay? So even if home values decrease, the borrower or their heirs can never be liable for any amount over the value of the home. That's a big one, right? So some mortgage programs are in fact recourse, where if your balance exceeds the property value, you are kind of on the hook for that debt. Not so in this case. Reverse mortgages, again, another big thing. We could find ourselves in another anomaly market, right? And I'm guessing, I don't know who's on the call, real estate agents, but if you were, practicing real estate in 2008, as an example, and when the whole housing market was kind of imploding on itself and values were going down, you kind of remember that anomaly market. If that, never say never, if we ever find ourselves there again, again, there is some protection with a reverse mortgage. Non-borrowing spouse protections, also another big one. So to be eligible for reverse mortgage, only one borrower must be over the age of 62. So if you've got, a husband-wife situation and one spouse is older, at least 62, you can still get a reverse mortgage, right? Texas, a little bit of a carve out there. If you're calling in from Texas, that state does in fact require that both borrowers be over the age of 62. But the cool one here is that eligible non-borrowing spouses can remain in the home without making monthly payments, even if the borrowing spouse moves to assisted living or passes away. So all of the protections that are afforded the borrower on a reverse mortgage do in fact extend to the borrower's spouse, even if they were not age eligible at the time that the loan was put in place. Another great protection here. Monthly payments are optional, right? There's a big misconception that on reverse mortgages, you cannot make a monthly payment. They are completely allowed. In fact, the borrower can choose to make a payment at any time. We encourage people to make a payment if they can. Product works very similar to an equity line of credit, meaning you can pull the money back out at a future date if you want to, kind of thing. But it's not, the situation where you set up a reverse mortgage and then all of a sudden your options have gone away, right? You can make monthly payments on reverse mortgages. Big misconception out there. Another one is the interest rate adjustment caps. right? These are variable rate mortgages, right? They're adjustable rate mortgages. You know, and there is in fact a limit on how much rates can increase over the life of the loan. In most cases, it's going to be 5% over the start. So again, even if we find ourselves in, you know, a very, very high interest rate environment, we are in a high one right now, but even if it goes higher, right, in a reverse mortgage, you do have some protection on how much that interest rate can increase on you. And the last one here is that there's no prepayment penalty at all. The loan can be repaid at any time. Right, the borrowers can also refinance out of a reverse mortgage if they choose to kind of pursue something else, you know, at a future date for whatever reason. So you're not like locked into this and stuck with this reverse mortgage. You know, plenty of optionality to it and plenty of protections as well. Let's talk about the reverse for purchase, right? Why we are all here. So this was actually introduced in 2008, and it provides buyers the opportunity to purchase a new home and get a reverse mortgage at the same time. The typical application is a buyer looking to downsize, right? So the benefits of this: optional monthly mortgage payments, right? So remember, this is a lifestyle type of a product. It is a cash flow type of a product. You know, for the scenario where we were looking at, where, you know, that the buyer is looking to fund their retirement with the proceeds from their home, this allows them to finance that property, right? Get a bigger home. They don't have to pay all cash, but they don't have to make a mortgage payment on it. So from a cash flow standpoint, they're in a much better position. No repayment until the home is sold, and then, you know, increased savings from sale proceeds. Again, you know, you are going to finance your new home. You don't have to pay all cash, and you're allowed to take that balance, the surplus from your sale proceeds, and use that to kind of fund whatever shortfall you have in your retirement. So what makes it good for retirees, right? Qualifying income and cash flows are the big ones. For borrowers who aren't earning a regular income, right? A reverse for purchase can offer a viable way to finance a new home. The loan amount is a function of down payment and age, not income. These borrowers also find the optionality of making monthly mortgage payments to be advantageous to their financial situation. So again, it's all about options. It's about freeing up cash flows. It's about, you know, being able to kind of, you know, sort of live a better retirement and still kind of, you know, hold on to your home, own a new property, whatever kind of makes sense for you. This is probably the most technical slide you're going to see in this presentation, you know, and I just kind of want to explain a little bit more how it is that we qualify a reverse mortgage, right? So what I've got here is, you know, this concept of leverage that's going to be based on age and interest rates, not income. So we've got this vertical axis here, right? LTV. I think everyone on this call should be familiar with that. It's loan to value, right? That's what that stands for. And what it means is the percentage of financing that you're able to get, you know, on your home. If I use just kind of round numbers, right? If it's a $200,000 property at a 50% LTV, that means it's a $100,000 loan. If I, you know, go a little bit higher, maybe it's a $500,000 property at a 50% LTV, it's going to be a $250,000 loan, right? Kind of makes sense. The horizontal axis here is the borrower's age, right? So what you're noticing is that the amount of LTV, like financing, that you're able to get for any property is going to be increasing as the borrower gets older, right? So, you know, using an 80-year-old customer as an example, right? Let's just say, you know, they were looking to buy a property, right? At 80 years old, it's you know, if I'm going to just look at this blue line here, it's going to be 49% LTV. So on a, you know, $100,000 property, that's a $49,000 kind of loan amount. Why I have three different colored lines here is to kind of illustrate the impact of interest rates, right? What I'm showing here is, you know, interest rates at 5%, 6%, and 7%, right? We're kind of hovering, you know, sort of right in between. Yeah, right in between those two. And what I'm trying to show is that in a lower interest rate environment, right, if I use this green line as an example, the amount of financing that a borrower is going to be able to get is going to be higher, right? It makes sense, right? These loans are in fact negatively amortizing. If the borrower chooses not to make a payment, that loan balance is going to start to get larger as time goes on. It kind of makes sense that in a lower interest rate environment, that interest is going to be kind of compounding slower. So we're going to give the customer more of a loan amount upfront, right, to start with. Conversely, in a higher interest rate environment, you'll see that the LTV, right, the total amount of financing is going to pull back a little bit because, again, the interest is expected to grow faster. And as a result, we're going to give them a little bit less. So not to bore you too much with the math here, it's really more just to kind of think about it and understand it that a borrower, who is older is going to qualify for more financing on a reverse mortgage than a borrower who's on the younger side of the age spectrum here. So let's look at a scenario, right? Because again, I like to kind of put, sort of a real kind of case scenario for us to look at here. And this is, we're going to take a look at an 85-year-old buyer with cash assets of $700,000, right? So this is that customer that sold, right? And this is what they have left over, right? The first kind of math that we looked at, the capital gains slide. This is the $700,000 they have left over, and they're looking to purchase a $500,000 home to be closer to family, right? The buyer's retired and has limited income. As a result, normal mortgage financing options are limited. With a traditional mortgage, right, they probably still have like Social Security. Maybe they have, distributions from an IRA account or a 401k. But there is some income there, and we can typically do a standard mortgage, but it's going to be small. They're only going to qualify for a $150,000 loan amount. This requires a very large down payment and requires monthly payments on top of that, which are going to impact the buyer's cash flows. At 85, though, we can also structure this as a reverse for purchase loan and finance $255,000, 51 LTV, right? 51% of 500,000 is $255,000. This leaves the buyer with more liquid savings and better cash flows because we have optional monthly mortgage payments. So let's kind of stack this up side by side and see what our different options look like. So here's the traditional purchase. Everyone's probably very familiar with this transaction, right? If we're going to borrow $150,000, that means we have to put a down payment of $350,000 to make this transaction work. Our remaining savings is $350,000. Remember, we have a $700,000 nest egg. We're going to put half of it down. So in this case, the buyer has $350,000 left in the bank. We've got a mortgage payment of $1,088. We've got taxes and insurance. So our total housing payment here, $1,848. So what's the summary of this? The summary, most of the savings has been applied to down payment. The buyer may have cash flow concerns with minimal options. I mean, signing up for a 30-year fixed mortgage, at 85, who knows what's going to happen in 5, 6, 7, maybe 10 years? Do they really want this payment kind of hanging over their head, for the rest of their life? Let's take a look at the all cash scenario, right? Because that is something that this customer could feasibly do. They're going to do a down payment of $500,000. They're going to pay all cash, right? The down payment, there is no loan, is the amount. So they're left over with $200,000 in their savings. So they basically depleted their savings. There's a small amount left over. The benefit, though, is that they don't have a mortgage payment, right? They paid all cash for the property, but they still have to pay their taxes and their insurance, which is $760 a month. So even though they're avoiding that monthly payment, right, they don't have much in terms of liquidity left over. And the last scenario here is the reverse for purchase. So they qualify for a $255,000 reverse loan, right? So that means a down payment of $245,000. So that's the smallest of these three options. It leaves them with the most liquid, right? They're able to kind of preserve that nest egg. $455,000 is what they have left. They have no mortgage payment. Remember, reverse mortgages don't require a monthly mortgage payment. You can make them if you want to, but you don't have to. But they do have to continue to pay their taxes and their insurance, which is going to be required for all three of these. So from a cash flow standpoint, they've set themselves up as if they had paid all cash for the property. But from a liquidity standpoint, they didn't have to pay all cash, and they were able to retain the bulk of their nest egg, to kind of pay for their lifestyle expenses. So again, we want to give our customers all the options, but you can sort of see how this reverse for purchase is extremely relevant for this demographic of customer. Let's look at another application here, right? This is another kind of common application. I want you to kind of just think about kind of just the power of this product, and that's our ability to increase purchasing power, right? So here's another scenario I want to kind of give some thought to. a 70-year-old retired couple selling a home and looking to downsize. After capital gains and their loan payoff and their transaction expenses, they're going to be left with $450,000 in sale proceeds, right? They found a new property for $600,000, right? It's the perfect home. That's where they want to kind of spend their kind of remaining years and age in place. But they ultimately don't feel comfortable taking funds from their savings to complete the transaction, right? They've budgeted $450,000 to make this work, and they don't want to take any funds, out of their retirement nest egg in order to bridge that difference. On top of that, because they're retired, they don't want to impact their monthly cash flows by adding additional debt. So in addition to that, they don't even want a normal standard mortgage. So at age 70, right, on the younger side of the spectrum, they can borrow $222,000, which is 37% of the $600,000 transaction price, and do the reverse mortgage with optional monthly payments. So looking at this, right, it doesn't take a PhD in mathematics to realize that if you're only going to spend $450,000, you can't buy a $600,000 home. You're $150,000 short. However, using a reverse for purchase, right, they can get the reverse loan for $222,000. Their down payment is $378,000. Closing costs, which I'm going to kind of talk about a little bit more, right? They're a little bit higher for reverse mortgages. So I wanted to kind of introduce this right now before I kind of go into further kind of explanation on the next slide of $19,000. So they've got funds remaining from that $450,000 sort of balance of $53K, right? So again, you can expand your increase, using three words that all mean the same thing, your purchasing power with the reverse mortgage. If you have a customer that says, hey, I only want to allocate this much to my home purchase, and I don't want a mortgage payment, this is another way to kind of bridge that gap, and they don't have the burden of monthly payments. Talking about closing costs a little bit more here, right? So they are going to be higher on these reverse mortgage transactions than what you're typically used to. Upfront mortgage insurance, right? Mortgage insurance is required for reverse mortgages, and it's calculated at 2% of the property value for most transactions, right? So if you're transacting on a $500,000 property, it's 2%, right? That's $10,000 is going to be the cost of the mortgage insurance. Now that is a big ticket item. I have to say though, relative to other programs like the FHA loan, as an example, that has a buy-in of 1.75%, right? So it's not completely out of proportion. It's really just that there is a little bit more of a transaction expense associated with the reverse mortgage. It's to pay for that mortgage insurance. That's what covers the non-recourse protections. There's also an origination fee, which is going to range anywhere from $2,500 to $6,000, depending on the size of the transaction. The typical trend there is, the higher the purchase price, the origination fee is also going to move in step, but it does get capped out at $6,000. That's a requirement of the program. And then, the other traditional third-party expenses, appraisal, title, escrow, stuff like that. That's part of the normal transaction. A cool thing though is that this loan program does allow for interested party contributions. That's actually a relatively recent development, where the buyer is in fact eligible to receive up to 6% of the purchase price, if you structure it as like a seller credit, as an example, to cover some of these costs, right? That is allowed for the program. Again, seller credits, just depending on kind of what's going on, they can make or break deals, right? So just know that, as much as these are big ticket items, you could feasibly structure it as something of a seller credit in order to get a deal done. I want to do just a kind of a brief, sort of just high level comparison between the two programs, right? So when you think about reverse, just remember there is in fact an age restriction. You've got to be 62 years of age or older for most of the programs. And a conventional mortgage, that doesn't apply, right? We underwrite off of income in the conventional space, the standard 30-year fixed. So there is no real age restriction. It's, kind of how much do you make is what dictates, how much you can borrow. Monthly payments are optional with reverse, where they are going to be required on a normal kind of 30-year fixed mortgage. You have to make your monthly payments. We do not have any debt to income ratio or FICO score requirements for reverse. It's much easier to qualify for, especially if a customer has less than perfect credit. There are, in fact, minimum debt ratio and FICO requirements for a conventional mortgage. On a reverse mortgage, typically the loan balance is going to increase, right? If you're not making mortgage payments, the interest is going to be added to that balance and it's going to grow over time. That's kind of the trade-off, right, of not making mortgage payments. So that balance is going to get larger kind of as time goes on. Hopefully appreciation in the home is going to outpace the growth of that mortgage balance. Whereas, in a normal mortgage, typically the loan balance is decreasing, right? A 30-year fixed has a principal and an interest component to it, and every month you're paying off a little bit of that outstanding balance. In both instances, property taxes, insurance, and maintenance have to be paid, right? You own the home, you got to pay your property taxes, you have to pay your insurance. That's going to be required for both mortgage programs. There is, this non-recourse feature, right, which is a great part of the reverse mortgage. If you don't pay a forward mortgage, a normal 30-year fixed, you do have the risk of foreclosure that you're ultimately going to be hit with. And again, as we think about a customer at this kind of point in their life, maybe using that 85-year-old example, there might come a time where they don't want to make that payment. They can't make that payment. Something might happen. You are at risk of having your home foreclosed on if your payments aren't made. And in both instances, the borrower, buyer, customer, they own their home, right? I don't know how reverse mortgages got this reputation of you not owning the property. I mean, it makes a lot of sense with a predatory past, if people losing their homes over kind of some of the lending practices that were in place. But the program is completely different right now, and I'm going to argue that it's probably one of the safest financial kind of products that is available on the market. Thanks to kind of the big government intervention, the borrower does in fact own their property with a reverse mortgage, just like they do with the conventional mortgage. And that's all I got for the presentation. Please reach out to your rate representative for more information. Most of you are on this call because you know somebody from the company, and they know all the details about reverse mortgages. So if you do have a scenario that you would like to kind of run, please reach out to your rate representative. Contact them directly. We just need to know kind of very high level information about the transaction you're looking to do, the borrower's age, the value of the property, stuff like that, and we can put together a proposal for you to take a look at, in terms of how we could structure a transaction with reverse. Again, my contact information is on here, ryan.ogata@rate.com, phone number 415-225-4003. If you have any questions about the program, you want to reach out to me, happy to kind of discuss this more. But thank you for spending time with us, and please send your business our way. Thank you.